Well, greetings to all my investment clients. First of all, apologies. I think I missed the last 3 weeks of our weekly stock market recap. Just got a little head cold last week. Prior weeks just got tied up preparing for tax season. So again, my deepest apologies. I know some of you have been asking when will be the next video. Well, I am recording this on February 15th, 2026. So feeling much better. If I cough during this presentation, again, my apologies. I still kind of have a nagging cough. But as usual, I need to read this disclosure. Again, just a reminder to my clients, but especially anyone else watching this video who is not a client. This is not intended as investment advice or a solicitation to buy or sell any securities or make any changes to your portfolio. Please seek investment advice from your current advisor or give us a call to get a free retirement risk analysis checkup on your portfolio. And again, at your leisure, you can stop the video and read the full disclosure. If you want more details about myself, Walter Mazars, or Trinity Wealth Solutions, you can go to this FINRA website and either type in my name, Walter Mazars, or Trinity Wealth Solutions, and you'll get the disclosure from FINRA website. Okay, so now that we got this out of the way, let's get into first I want to kind of present the economic outlook for pretty much 2026. Again, this is from research, from markets, what they're thinking. I personally, it's nice to look at, but reality is, are these predictions or economic outlooks will come true in 2026? Again, nobody knows for sure, but these are experts that are kind of predicting, looking into their crystal ball and saying, hey, what do we think economically is going to happen in 2026? So week ending February 13th, 2026, inflation cooled. There was a CPI report. Inflation is running about 2.4%, below 2.5 forecast, so a little cooler than expected. CBO, which is a government arm, kind of debt warning that by 2036, we're going to hit 20% of GDP. That's concerning because there's a lot of issues with that. And retail sales, rose by 5.7% year over year growth. So that's, consumer is still kind of spending, but with some caution. So January inflation mixed signals, cooling, headline CPI 2.4, the forecast was 2.5. Core CPI, meaning this is minus energy and food, is 2.5, lowest since April 2024. Energy down 1.5%, and gasoline, gasoline down 7.5% year over year. So the energy, that's good, gas is good, but pressure points, airfares still increased by 6.5%, steepest in 4 years. Food 2.9% annually, but that's a basket of food. But if you ask my wife or anybody else who goes shopping, cumulative cost of food has dramatically increased. Beef up by 15%, coffee, and that's due to supply constraints, and coffee up 18% against supply constraints. So kind of a mixed bag. Inflation, yes, you hear that inflation is cooling, it's stabilized, but one of the things that's not talked about is the cumulative for the last 3 years, inflation in the average of all goods and services went up by 25, maybe 30%. Unfortunately, wages did not come close to that. So that is concerning. Fiscal outlook growing concerns again. CBO, which is the arm of the U.S. government that kind of tracks the federal budget and deficit spending and our debt. Again, federal debt to GDP ratio by 2036, 120%. That's quite high. Key drivers: internal interest costs growing from 3.2% of GDP, 970 billion in 2025, to 4.6%, 2.1 trillion by 2036. So these are, what this means is servicing debt. Just like if you had a loan, if debt keeps increasing, your interest servicing that loan is gonna increase, and that's not a good trend that we want to continue. Social Security, again, they're predicting that it's going to be insolvent by 2032. Word of caution. I can guarantee you politicians will not allow Social Security to go bankrupt. That would be a political suicide. So they'll do everything possible to make sure that Social Security is solvent for retirees and future generations. 2026 growth forecasts, resilient but uneven. So again, you have to take this with a grain of salt. Goldman Sachs, Morgan Stanley, Price Waterhouse, Deloitte. I'm not sure who RSM is. CBO, that's the government arm. They're kind of predicting, GDP growth for 2026. So Goldman is leading 3%, Morgan Stanley 2%, Price Waterhouse 2%, Deloitte 2%. So it's, if you were to look at the average, I think 2% is kind of the consensus. But you can throw that out the window. I mean, that could dramatically change in 2026. Again, nobody has a crystal ball. These are just probabilities based on current conditions. So we'll just have to wait and see. Definitely that indicates economic slowdown. Usually you want to be around 3% growth or higher. So 2026, if we fall below 2 or even 1%, again, the economy is definitely slowing down. Global economic growth for 2026, global 3.3, IMF, United States 2 to 2.5% kind of consensus. China 4.8 to 5. Now again, historically this is very low. China was growing at 10, 15% GDP. So for them this is not good. Eurozone, probably the weakest. Excuse me. 1.1 to 1.3. India 6.7. Again, India was growing much higher. So the trend is economic. The GDP is definitely slowing globally all over the world. And again, that's just signs of economic slowdowns. Top risks for 2026. Tariff uncertainty. Supreme Court ruling on tariff authority could reshape trade policy. Goldman Sachs estimates 1% inflation impact. I personally disagree. Inflation is all they've talked about tariffs, for the last 6, 7, 8 months. It's going to cause inflation. No, it has not. Remember, the number one cause of inflation is a monetary issue, meaning too much money chasing too few goods. We are not in that stage. There is an abundance of money, especially, people in the lower tax brackets. They're struggling. So there is not an oversupply of money, just like we saw in COVID, which caused inflation. It's actually the other way around. So less money to spend, always monetary policy will say we will not cause inflation. Again, because we don't have a shortage of goods and services like we did in COVID, the threat of inflation, everything I read from other experts, is pretty minimal, probability-wise. Again, going back to the fundamentals, what causes inflation? Tariffs do not cause long-term inflation. Stagflation threat if labor market weakens, while tariffs, again, I disagree with that. Tariffs push inflation higher. They don't. I'm sorry, but I hate to disagree with the consensus. Tariffs do not cause long-term inflation, period. It's always a monetary issue. Too much money chasing too few goods. AI, artificial intelligence, valuation risk. Tech valuations depend on AI delivering productivity gains. Correction could reduce global growth by 0.4%. Again, the euphoria right now is everybody's spending tons of money on AI, but the key is we're spending, but do we see really productivity, investment on return on investment on those companies that are expanding and spending tons of money? Fiscal sustainability. The government. 45% OECD sovereign debt maturing 2025-27. Rising rates increase refinancing costs. So fiscal, can we continue spending? Fiscal means government spending. Can we continue spending the way we're spending? No, it's not sustainable. So there's that risk also, economic risk and potentially, excuse me, stock market risk. So AI double-edged sword for 2026, 1.2 to 1.3 of GDP's AI data center spending. So that's a huge portion to GDP. So GDP is counting on AI spending tons of money. If they see, and it's starting to crack, spending all this money, but what's the return on investment? So upside productivity gains could boost growth by 0.3% in 2026. Again, that's a probability. We don't know if that's going to happen. Current status: over 50% of firms invested in AI in the last 12 months. Labor displacement concerns rising. Productivity benefits still mainly in tech sector. So downside: valuation correction could reduce growth by almost 0.5%. So still lots of AI was kind of the darling in 2024, 2025, and the AI bubble is starting to crack a little bit, and that could pull, economic cycle, the stock market down. Labor market stabilizing but soft. Unemployment rate 4.4 to 4.6. Expected range in 2026. Monthly job gains 50,000. That's very low. You should. I think the average, if you have good economic growth, positive, and it should be growing well over 100, pushing 200,000. So we're way below the average. Wage growth 3.6 to 3.8%. Again, that's kind of average. People see different. Different wage growth. Again, right now that's kind of keeping up with current inflation, but if you add cumulative inflation, we're nowhere close. Wage growth is not keeping up with cumulative inflation, which over the last 3 years has ranged 25 to 30%. For the reserve patient approach, 2 cuts are expected in 2026. Again, target 3 to 3.25% by year end. So again, nobody knows for sure, but that could speed up the probability of the Federal Reserve cutting rates if we see greater deterioration in the workforce, meaning more layoffs, more people are losing jobs. The Federal Reserve could react very aggressively and push interest rates down to even as low as 2%. But again, we won't see. We just have to wait and see. The K-shaped expansion, the upper tier, S&P 500 gains, boosting wealth. Markets have done well. There was some pullback. High-end consumption strong. AI sector job growth. The lower tier, the K-shaped economy. I talked about this a little bit. If you look at the letter K, the line going up, that's the upper tier. Those are doing fine. The part of the K going down, lower tier, is actually struggling. Limited wage gains, higher prices persistent, spending growth only 1%. So it's a mixed bag of what the economy is doing. So key takeaways: growth resilient. I don't know if I would call that 2%, but below historical average. Inflation moderating but sticky. Feds to cut cautiously. 2 cuts likely. Again, these are probabilities. Nobody knows for sure. Fiscal trajectory unsustainable. Debt headed to 120% of GDP. AI presents both opportunity and risk. Productivity versus valuation concern. Labor market stabilizing, but with supply constraints, not cyclical strength. So there's slowing in the labor market, definitely. And the K-shaped recovery, raising inequality and sustainability concerns. So, it's kind of, everybody says resilient, but it's starting to teeter. Growth continues, but depends on narrow set of forces: AI, fiscal support, and financial confidence. There's definitely concerns, in the economic cycle right now. This is going to be a little bit longer video, so just bear with me. So I wanted to kind of give a perspective of economic landscape. So let's talk about kind of, again, big picture. And this is, I've talked about this, the 4 stages of the economic cycle, or really, it's the stock market, which has a play, the go side inside economic cycle, and how will stocks do. Now we get research from Chris Vermeulen, the technical traders, and they believe, big picture, they're big proponent of the economic and, the 4 stages of the stock market. And then which asset classes perform the best in these economic cycles. So overall, when GDP, depending on what GDP is doing, what inflation is doing, there's different asset classes that will do much better in these economic cycles. The best defensive is for if there is, phase 4 contraction, is pretty much cash is the best defensive to stocks, meaning be out of the market. So which asset classes outperform in each phase? So we are here. This is what we believe. Phase 3, slow down, topping stage. And the next stage would be here. Correction. GDP falls, inflation falls. And again, what's the best asset classes? Is long-term bonds, gold, and cash. Phase 2, expansion, GDP, inflation is rising. Best is commodities, gold, silver. And what you kind of at the tail end of phase 2, we are in phase 3. So the current strategy, phase 3, slow down, rotate to gold, silver bonds before phase 4 correction. Again, you can't time this, but historically that's kind of what each asset class has done. So asset class performance by economic phase. So phase 1, stocks, excellent. Gold, not so good. Technology, excellent. Bonds, poor. Commodities, okay. Cash and bill, worst. Phase 2, expansion. Again, stocks, good. Gold, maybe good. Technology, excellent. And bonds are the worst. Commodities tend to be also kind of excellent. Cash and T-bills, poor. Phase 3, that's the phase we are in. That's our belief, and that's what technical analysis shows us. So stocks, it's kind of a poor because you're at the topping stage. So you have to be careful and be cautious that there could be a severe pullback. Gold is excellent, as I'll show you in the charts. That's an excellent defensive play. Technology is not good. It's still actually the worst. Bonds, kind of fair. Commodities, poor. And cash and bills, excellent. So, and I'll show you that we are kind of majority of our asset allocation is in these two. Precious metals and cash and bills. And a little bit of stocks. Phase 4, this is the contraction. So stocks are the worst. Gold could be very good when that phase 4 kicks in. Technology would be the worst. Bonds, excellent. Why? Because when there's contraction, interest rates start to come down, and long duration bonds are an excellent asset class to get into. Commodities are poor. Cash and bills are good. So, again, market psychology cycle, market phase, bottom, phase 4, and emotional. People want out. They start to sell at the bottom if they didn't get out of the market. Price action at the lowest point, investor behavior, maximum opportunity, fear dominates. So again, this is where opportunities are created in phase 4. Early bull phase, hope, optimism, people start to reinvest back into the market, rising steadily. Price action meaning skeptical buying, cautious reminds. Mid-bull phase 2, belief, thrill, accelerating up, price, confidence builds, FOMO starts. So people are starting to pile back into the market. Peak phase 2 and euphoria, excitement, highest point, maximum risk, greed dominates. Early bear phase 3, kind of what we're in here. Anxiety, denial, declining prices, ignoring warning, holding on. And then mid-bear, fear, panic, falling, everybody wants out, falling fast, capitulation, selling, losses, mounting. Current market 2026, early bear phase 3. Anxiety and denial emerging as topping pattern form. So again, as I'll go into the stock market, how are we positioned based on these market psychology and economic cycles. So let's get in to the actual portfolio. And our clients we do not have exposure to long duration bonds, but I just show that we have small exposure to SPY, about 15%. Gold, we have about 30% right now, and this is precious metals, a basket. We only have 10% exposure, and TLT none. So as you can see, let's just do a 1 month Now we got into gold. Sorry, let's get back to here. It was December 3rd. So you can see this is where precious metals, gold, started to go up. So and then unfortunately, yeah, there was a pullback. So our clients saw their portfolio pull back. Well, we're still in the money in gold. So if we look at from the time frame that we got in, which was, we were at, so we're still in the money in gold. Now we did get into the precious metals kind of ETF. That we're not in, we only have a 10% exposure, so we're kind of underwater at this point, and we probably will be getting out of this position, and eventually probably even maybe next week out of gold, and almost be completely probably out of the market within the next or 2 weeks, depending what technical traders, what kind of signals they'll give us. And as you can see, the stock market has been kind of flat, about 0.5% for 3 months. If we look at year-to-date performance, SPY is a little negative. We're not in TLT, but as you can see, gold is up and precious metals are up. If we look at 1 year, obviously, excuse me, gold had a very good run up, pullback, but still for 1 year, gold is up 73%. Precious metal basket is up about 91%. But it's this is the topping stage. In hindsight, yeah, we should have got out here. This 1 day correction was totally unexpected. Usually it doesn't drop. So if we look at gold, it was up 81%. And so it dropped 20%. That's very unusual for gold to drop pretty much in a couple of days. Very unusual. It's kind of recovering, going back. So we're waiting for, I'm not sure if I'm going to wait till we recover to the peak again, but this week will tell, and we may just sell to protect the gains we've had so far. So for 5 years, obviously precious metals have outperformed, but typically we are on the stage 3, and in the correcting phase, everything gets pulled back. Even gold, precious metals. That's why we're cautious, and we probably will be out because there's a delay. First, the stock market starts to pull back, and then eventually gold and precious metals follow. So we don't know when. These are probabilities again, so we don't know for sure when that correction may happen. So as far as I'm trying to present what we're thinking. What are we doing with clients' portfolios? So in a nutshell, we're actually doing much better than the broad market with our exposure, kind of 40% to precious metals. That's outperformed the broad market, but we need to protect those gains going forward. So stay tuned. This week, I may be making changes to the portfolio depending on the price action momentum, just to protect the gains that we've made. So Again, I apologize for the coughing, first of all. Again, I know this video is much, much longer than I usually do, but I felt I felt it very important to present kind of the economic picture, market cycles, stock market cycles, and then currently what is the market doing. So again, thank you for watching. Hopefully everybody had a great Valentine's Day, February 14th, yesterday. And stay tuned for next week. I promise I won't be skipping, a gap of three weeks of not doing a stock market recap. So hopefully you enjoy this presentation, and we will see you next week. Take care. Bye now.